Hello and welcome to a large session in mortgage servicing called loan servicing players. So as discussed in the previous section, some originators sell the loan servicing rights to firms that specialize in the area so that the originator themselves may focus on origination only and leave loan servicing to specialized entities. Some of these specialized entities are the firms that are pure loan servicers who purchase the pools of the loan after origination and manage only the servicing function. Other firms perform this task in varying degrees and at various geographical coverage. Given the variety of firms involved in the loan servicing, it is worthwhile to discuss different players involved in this particular area. Loan servicers. So loan servicers are specialized players and perform the major servicing functions themselves. This includes ensuring that the cash flow reach their appropriate destinations, that is like the investors either directly or by forwarding them to the master servicer or the trustee in a timely manner. The servicer is also responsible for escrow administration and for investor reporting. So when the originator sells the loans into the secondary market with a clause allowing it to continue servicing the loans, servicing rights are said to be retained by the originator. Because servicing produces revenue, everything else being equal, loans with a servicing release sell for more in the secondary market than those where servicing is retained. If the loan is sold in the servicing market with a servicing released, security issuers can also sell the loans in the pool backing their securities, or a third party can be contracted to handle the servicing for the issue. So as a result, a mortgage issuance not only includes the details concerning loan characteristics, but also the servicing requirements associated with underlying mortgages in the pool. Among other elements, these pooling and the servicing agreements P&S specify when and how servicing can or must be transferred in the event that the servicer fails. The P&S and S also specify the nature of servicer's responsibility during the default, delinquency, and the foreclosure. So basically, the industry divides these into collections, which are loans less than 30 days past due. A default is a non-performance of a contract more than 30 days past due is called as delinquent. So often, the primary servicer will be responsible for managing these processes, trying first to cure the loans through the workouts and potentially through the modifications, and then handling the foreclosure process for the loans that cannot be cured. Sometimes these functions are referred to as a special servicer who excels at dealing with the problematic loans. The primary servicer may also be obligated to advance the delinquent principal and the insurance to the investor, even though it is not received from the borrower. For the servicer, compensatory repayment occurs only if the loan cures or when cash flow from one or more sources of the credit enhancement is submitted for the cash not supplied by the borrower. The nature of the servicer's advance requirements are specified in the P&S. Even though they are later reimbursed, the opportunity cost of the funds advanced prior to the repayment usually provides a strong incentive for the servicer to avoid the foreclosure. At the same time, however, they imply that once loans are deemed unrecoverable, servicers should foreclose quickly to minimize the losses. The P&S typically also specifies master servicer, whose function is to protect the interest of the investors by overseeing the actions of the primary servicers and any others involved in the issue, and by ensuring timely remittance of the funds. Under normal circumstances, the master servicer's duties are modest and involve compensation on the order of approximately 8 basis points in the prime market, whereas primary servicing in the subprime market typically is on the order of 50 basis points approximately. So in cases where the primary servicer becomes unable to perform the duties, however, the master servicer will be responsible for collecting principal and interest and ensuring that they are transferred to the appropriate parties in a timely manner, either by performing the primary servicer role themselves or by ensuring the transition to a backup servicer. Depending on the specifics of the P&S, the master servicer may also be required to advance principal and the interest to the trustee or the investors in the event that they are not forthcoming from borrowers. A third class of servicer is the special servicer, who is responsible for working the more difficult, often non-performing loans, first payment delinquencies, and or handling the real estate wound process, which is REO. Special servicer compensation typically reflects the challenges of these more difficult loans. So a special servicing contract might stipulate the bonuses for the loans in the foreclosure proceedings, that the servicer returns to normal cash flowing loan or to fully cured status, and penalties for the underperformance. The special servicer puts in best effort to bring the loans back to the normal cash flow status. Sometimes, if the borrower has recently lost a job or another source of income, the lender might be willing to temporarily reduce or suspend the payments. This option of foreclosure is called as special forbearance. All right, a final wrinkle in the servicing nomenclature is the sub-servicer. Okay, these participants perform much of the primary servicer's role on the fee basis, but do not actually own the servicing rights. Okay, so sub-servicing and servicing are the not mutually exclusive business lines, and many servicer are both the primary and the subprime side do both. A sub-servicer, for example, may specialize in document management and perform all or some of the document custodianship functions for the primary servicer. A primary mortgage servicer's activities in the relationship with other servicers are shown in this particular diagram. So to summarize, okay, the loan servicing players can be segmented into three categories depending on the roles they play in the servicing of mortgage loans. So these players have been briefly elaborated. I'm going to explain about the main important points, what the master servicer perform, primary servicer, and sub-servicer, and special servicer are going to perform. Let's learn about master servicer. Assumes ultimate responsibility for the administration of all the mortgage loans contained in a commercial mortgage securitization. So master servicer handles all reporting and remittance as required by the particular pooling and servicing agreement with the client, and he makes remittances to the client or the trustee plus periodic reports to the trustee and rating agency, and assures diligent loan payment, collection and administration by each primary sub-servicer regardless of relationship with the mortgagor, ownership of any certificates, obligation to make the advances, compensation, or the cost reimbursement. All right, what all the things are done by the primary servicer? Basically, he provides monthly billing statements to the borrowers, timely collection and application of the payments, escrow administration, financial statement analysis, and property inspections. And he prepares and provides periodic reports and remittances to the certificate holder or the master servicer. And he performs all the tasks and the obligations required by the servicing agreement with the certificate holder or the master servicer. All right, so what are the things which are done by the special servicer? The special servicer, he assumes the responsibility for the administration of a mortgage loan after a servicing transfer event occurs, such as like a balloon payment on a mortgage loan becomes 30 days past due, and regular monthly payments or other required payments remain unpaid for at least 60 days. A default occurs that materially impairs the value of a mortgage property and adversely affects the interest of the certificate holders. The mortgagor is declared bankrupt or insolvent, or consents to the appointment of a conservator, receives, or a liquidator. The mortgagor admits in writing an inability to pay the debts. The master servicer receives notice of foreclosure or similar proceedings. Special servicer, he develops and executes effective workout plans for the loan repayment, and it transfers the loan administration back to the primary server if the situation is positively resolved, and says so for the certain period of time. All right, so there are a few other players in the loan servicing. One of the player is called trustee. The trustee provides oversight of the deal between the loan originator and the secondary market investor, managing the payments of the cash to the investors. The trustee often also acts as the paying agent and custodian for loan or documents for the deal. All right, so what are the paying agents? So the paying agent distributes each cash bond payments to the investors on a monthly basis. So the master or servicer, primary servicer deposits cash into the dedicated certificate accounts opened by the paying agents, and the paying agent distribute the cash to individual investors based on the reported distribution amounts provided by client's bond admin department. All right, who is primary custodian? So there is usually a main custodian that holds loan documents in the trust on the behalf of the investors in a public security deal. There may be more than one custodian for the deals. And primary collateral trustee. So there is usually a main collateral trustee that has signing the authority on behalf of the investors in a public security deal. So there may be more than one collateral trustee for the deals, as the collateral trustee is assigned at the loan level. Final note. So this ends the mortgage servicing module. Hope you enjoyed all the lectures. So I will see you in the next very interesting chapter, which is called as secondary marketing. Thank you and see you in the next chapter.